What's up, everybody? Welcome back to my channel. This video is going to be about how the market is designed to trick you, how the market always will stop out weak hands to gain your liquidity. This is something that a lot of people struggle with. How many times have you entered a position and right away the market started reversing on you and you stop out? And then you stop out, and then a minute later, 2 minutes later, the market starts reversing, and what was a red trade you took a loss on now would have been a green trade if you just held on, a couple minutes after. So the market is designed, like I said, to trick you. This is the basis to my trading strategy. Smart money, big money needs retail traders. We are all retail traders. They need our liquidity for them to benefit and for them to gain. So we need to switch our mindset up a little bit, trade a little differently, and understand the psychology of the market. And this video will definitely help with that. Before we do begin, all I ask is if you enjoy my content, if you're new here, make sure to subscribe to my channel. And if you want a very good trading resource, I'm going to link my Instagram in the description below. I post daily trading recaps along with very good trading tips and tricks. The link to this will be in the description below. It's definitely a good resource, and you're definitely missing out if you're not following it. And now let's get right into the Discord. I want to show you exactly what I was watching on March 10th. This was the pre-market plan, and this is going to lead us right into the first example. So every morning I post pre-market plans in the Discord. It has to do with my supply and demand strategy, which I teach in the course. And these give me my levels where I want to be an active participant in the market. And depending on the other participants in the market is going to decide whether or not I want to enter a position or not. So Boeing here was the plan. We had a 4-hour demand speculating that it was going to form overnight. And then we had demand lower. And if price pulled back, it was going to pick up more orders, but if it left without us, I was watching the 235 to 237 area for a long, as we do not have much supply overhead. So the market works that it moves from imbalance to balance, balance to imbalance. So these zones, my supply and demand zones, are imbalances. And right up here, we had the 2-hour supply zone. That was the area where I wanted to act like a magnet. There was not a lot of things stopping us lower. So the market opened up. We had a downtrend line over here. If I pull up a little bit of a higher time frame chart, we had a nice downtrend line from the December highs. Fast forward to the March high, pivot high made, and now we started gaining some momentum. Volume was coming in, and we had that nice break over the 235 to 237 high. So right then and there, my mindset is I'm a bull. Now, I can't really be bearish because we're not triggering supply. We're above demand. We have strong buying coming into the market. So my mindset is to maybe avoid shorting supply and maybe longing pullbacks or watching out for any intraday context or intraday clues that are telling me buyers are here and ready. So I'm very against, if you've been following me, I'm very, very against high a day breakouts. It's a perfect trap for market participants, retail traders to go long high a day. Everybody knows what high a day, low a day is, so everybody does it. Everybody does buy a high day break. I'm not going to bash it because it's acceptable. You could grab a couple points out of it. For example, if you long the 238 break, you could have got a full dollar out of the next candle. Volume was increasing. This is where volume comes in key. Now, a quick dollar break on Boeing with 50 contracts, you're going to make good money. But a lot of people hesitate. They don't enter right away, and their entry is lagging. They get in near the top, and now they're in a position, let's say, they don't buy the 238 break. They don't buy the 237 break, or they don't buy the, the dip. So they get in above 238. They get a 230, let's just call it a 238.60 entry, 40 cents below the high. Then the market starts chopping around, starts coming down. It doesn't work out right away. Now it's playing games. We start dumping. Look at that, the highest volume of the day. High volume with no intent, with no continuation is absorption. This could be seen as accumulation, where large market participants are trying to get in a long position, and now all they have to do is stop out weak hands. So put yourself in the position really fast of a participant. You're long up here at 238. What is the market going to do? How many traders have gotten a position and immediately the trade does not work out and immediately they stop out? So it comes down. Let's just call our stop loss below 235, maybe below this low here at 234.75. So the market comes down. We stop out down here. What looked like a very good entry here above 238, 237. The entries down here at the market open when buying volume started coming in. Once we got above 235.50 into 237 where the market started having a hard time. We're defending VWAP, but now we're coming down. You have a lot of longs trapped up here around the 238, 237.50 area. What is the market going to do? It's going to stop out weak hands. I'm sure if you looked at the option chart of Boeing, let's just say the 240 calls, maybe the 237.5 calls, I'm sure you would have seen a lot of volume coming down right here because of the market participants stopping out, causing liquidity. And look what happens. You stop out down here, the market starts reversing. We break the high now. And again, traders buying the break out of the high. If you're in with too large of a position size or you're not comfortable with your risk management, let's just say you buy the high at daybreak above 239, you get in at 239.40, boom, a quick dollar move down. A lot of traders that don't understand risk management or are too concerned with the money aspect of trading are going to stop out on a quick 5-minute, dollar drop on Boeing. Then the market starts chopping, starts moving back up, but little small price movements with too large of a size or poor risk management is going to stop you out. And again, the whole idea here is buyers are strong. Buyers are proving to me that the market is strong. We're in a very strong uptrend. Dips are getting bought. We're getting accumulating shares. Dips are getting bought. Now we're coming into supply. I'm really not going to be interested in shorting this because of how strong buyers are proving to me. I'm going to maybe wait for extra confirmation because then the market did start moving up and it did start rallying. So that was Boeing. And then the following day, we opened up, and the plan, if I pull up my Discord, let's just go over, let me pull it over here. So the plan was the 250 we were opening up. I wanted this supply zone to act like a magnet, and we started rallying into it, and market kind of chopped going into that session. But now we have Facebook. This is really the perfect example I wanted to go over. So let me pull up the plan for Facebook in my Discord. So we had the plan last on the 10th, so Wednesday, and it took about a day for it to work out. We had the supply at 268.68 that I was being cautious at. And if I go back to that day, we rejected the 268.58 supply zone. We started selling off. We popped. Rallies got sold into. But yesterday, on Thursday, March 11th, if I pull up Discord, the plan on Facebook was we were gapping up $4 into our 268.58 supply zone. The only problem I have with this name is majority of retail is watching the same thing, and the market is designed to trick the majority of retail at all costs and do the opposite of what everybody does. Again, how many times have you entered and the market tricked you out, and you say, the next trade, if I want to buy, I'm going to sell because my calls never work out. Or I get in, the market starts reversing, I stop out, and now it starts moving into my direction. The market is designed to feed off of your liquidity. It's designed to trick you at all costs and do the opposite because the opposite participants with the big pockets, fat pockets, and the smart money are designed to win in this game over retail 9 times out of 10. So you have to think like them, and that's the basis to my strategy that I teach in the course. So the plan for this day was you need real convincing buying and a hold or base above 258 or 268.58 for me to consider a long, and we have to show strength with the overall market. We don't have too much supply above, and the nearest supply was 283. So I pull up Facebook. This was on March 11th. The market was gapping up. This was yesterday, so the market tested all-time highs. We were very strong. It was very apparent. And the same exact formation formed here. So if I pull up a 1-minute chart, let's go to Facebook on this day. So here's our 268.58 supply zone. Again, this sliced through the zone like butter. There was not one sign of selling, and that means there's zero reason to short this zone. This zone is a supply. There are sellers evident here, but because we had strong buying down here, we had very fat green candles to the upside. It's telling me buyers are buying into this market. And if you compare the volume to, let's just say the open the previous day, let's see if we could get a nice picture here. The buying volume was pretty evident compared to the previous day. The market's moving up. The S&P is strong. NASDAQ is strong. Everything is leaning more towards the buy side. So now we have buyers coming into the market. And this was a zone, the 268, 267 area was a major resistance zone, which also lined up with supply a little bit overhead. So everybody was going to be watching a 278, 268 break. Finally got that buying coming to the market. And I'm not going to lie, a lot of traders were watching this 273 break. Again, there's nothing wrong with scalping high day breaks. This was flagging near the highs, basing near the highs, very bullish sign. But if you look, the next candle, we broke above 273. Again, if you look at the option contracts, these would have got destroyed. Everybody's watching this 273 flag break. Everybody's doing it. It's not going to work out. It goes with anything in life. You have to find what other people aren't doing. So you buy a 273 break. What happens the next candle? We start coming down. People start sweating. Adrenaline's pumping. People start panicking. Next candle, 273. Oh shit, what am I going to do? I'm down $1,000 here. Am I going to sell or am I going to hold this? I can't hold this because, this could be a $5,000 loser if I keep holding it. Next candle starts coming down. We start holding 273. Start selling off a little bit. Then the market starts coming up. At this point, if a lot of traders, this goes with market psychology. They see this fat red candle coming to the downside. They stop out. This is about 2 points from the highs. So 2 points with 50 contracts scalping Facebook, it's not going to be a good day. So we come down and the market starts coming back up. So now we have a high put in. I'm not a huge fan of this excess, this upper wick. But the market starts coming up. We test the high. If traders are anticipating a breakout, they're going to get stopped out here. Then we start breaking the high. Nice volume, nice thick candles. But again, the market really lacks follow through. Yes, you could get a quick 70 or so cents. Nothing wrong with that. You can make a living off of that. But then the market starts chopping, and then boom, we get a quick liquidity push down. This seems like the end of the world to traders. We break below VWAP. We break below the support. But again, this drop is just traders leveraging into their position. They're accumulating more shares. They're stopping out weak hands for another leg higher. And the market starts moving. We eventually start consolidating near the highs. It's somewhat of a choppy mess. However, this market does rally. If I zoom out, and it was an all-day consistent grind uptrend. So you have to understand market psychology. You have to understand how to read volume. You have to understand supply and demand. And you have to understand how institutions and smart money, big money, will trick you out of this game because they need your liquidity. They're like sharks in the water. They're looking for retail traders to bleed. As soon as you're bleeding, as soon as you start bleeding crazy, they're gonna eat your orders. They're gonna eat your bait, and they're gonna make the money off of it. So I hope this video helped. Hope you understand my mindset a little bit. If you learned something and you want to learn more, check out the course on my website. Follow me on Instagram. I'm telling you, it's a good resource. And also subscribe to my channel. Drop a like on this video. Besides that, see you all at the next video. Peace.